If you have watched more than 3 videos on trading, you have heard the golden rule. It is repeated by every guru, every mentor, and every textbook in the industry. It is etched into the commandments of trading education. Never risk $1 unless you can make 3. Always aim for a risk-to-reward ratio of at least 1 to 3. They show you the math, and on the surface, the math is seductive. It is mathematically irrefutable. They say, look, with a 1 to 3 risk-to-reward ratio, you can be wrong 70% of the time and still break even. You can be a terrible trader, lose 7 out of 10 trades, and still make money. They present this as the holy grail. They tell you that the secret to trading isn't being right. It's having a positive expectancy. They tell you that win rate is vanity and risk to reward is sanity. And logically, they are correct. Mathematically, a 1:3 system is superior to a 1:1 system. But there is a problem. A massive, glaring problem that almost no one talks about until it is too late. You are not a calculator. You are not a spreadsheet. You are not an algorithm running on a cloud server. You are a human being. You have rent to pay. You have an ego. You have dopamine receptors. You have anxiety. Mathematically, a 30% win rate is profitable. Psychologically, a 30% win rate is torture. The industry sells you a mathematical fantasy that ignores biological reality. They sell you a system that works in a backtest but fails in the human brain. They sell you the dream of the sniper entry that runs for days. But they don't tell you about the weeks of bleeding that happen between those entries. Why do 90% of retail traders fail? Is it because they don't understand risk to reward? No. Every beginner understands it. They fail because they quit. They fail because they blow up emotionally. They fail because they cannot endure the psychological pain required to execute a high risk-to-reward strategy. We need to have a very honest, very brutal conversation about optimal strategy versus sustainable strategy. In this video, I am going to argue something controversial. I am going to argue against the grain of almost every educator on YouTube. I am going to argue that for the average retail trader, for you, aiming for a 1-to-1 risk-to-reward ratio is vastly superior to aiming for 1 to 3. We are going to dismantle the dogma of the home run and replace it with the philosophy of the base hit. We are going to shift the goal from mathematical perfection to psychological survival. Because a strategy that makes less money on paper, but keeps you in the game mentally, will always beat a strategy that makes millions on paper but causes you to quit in real life. Chapter 1. The probability of pain, the losing streak. Let's look at the dark side of the 1 to 3 ratio. The side the gurus don't put in the YouTube thumbnail. The side that destroys accounts in silence. To achieve a 1 to 3 ratio consistently, you are implicitly accepting a lower win rate. The market does not hand out 3R trades easily. They are rare. Most traders aiming for 3R have a win rate between 30% and 35%. That's fine, they say. The math works. 1 winner pays for 3 losers. But let's look at the probability of pain. Let's look at the distribution of those losses. If you have a 35% win rate, do you know what your probability of a losing streak is? Over a series of 50 trades, you have a statistical guarantee near 100% certainty of facing a losing streak of 8, 10, or even 12 trades in a row. 12 losses in a row. Imagine that reality. Visualize it. Monday loss. You say, it's okay. Stick to the plan. Tuesday loss. Trust the edge. Wednesday loss. You start to feel a little annoyed. Thursday loss. You check your settings. Did you miss something? Friday loss. You go into the weekend down 5%. You feel terrible. You are snappy with your family. You doubt your strategy. Next Monday loss. Next Tuesday loss. By the 8th loss, you are not looking at your positive expectancy equation. You are looking at a bleeding account. You are questioning your sanity. You are wondering if the market has changed. You are wondering if your edge is gone forever. The math says keep going. Your brain says stop. This is where the retail reality crashes into the hedge fund theory. A hedge fund or an algo can handle 15 losses in a row. They have infinite capital. They have risk managers. They have no emotions. The computer just executes the next trade. You have a $5,000 account and a mortgage to pay. You have self-doubt. When a retail trader hits 8 losses in a row, they break. They stop taking the next trade, which, ironically, would have been the 3R winner. Or they start revenge trading to fix the streak, doubling their risk. Or they change their strategy entirely because this one doesn't work anymore. And they start the cycle all over again with a new indicator. The 1:3 strategy requires you to have the emotional resilience of a Navy SEAL. It requires you to walk through fire and not flinch. Most of you are not Navy SEALs. You are normal people with normal stress tolerances. You cannot handle 2 weeks of losing without it affecting your decision-making. Now, contrast this with the 1:1 strategy. If you aim for 1:1, you should be targeting a win rate of 60% to 70%. With a 60% win rate, the probability of 10 losses in a row is statistically microscopic. It is an anomaly. Your losing streaks will typically be 2 or 3 trades, maybe 4 on a bad week. The pain is short. The recovery is fast. You never reach the breaking point of your psyche. You never enter that dark place where you want to give up on trading forever. A 1:1 system protects you from the dark side of variance. Keeps the drawdowns shallow, not just in your wallet, but in your mind. Keeps you safe from your own despair. Chapter 2. Dopamine Starvation, the Biology of Winning. We have to talk about dopamine. Not in a drug addict way, but in a performance fuel way. Your brain runs on chemical feedback loops. I want you to imagine that winning trades are oxygen. For a trader, confidence is oxygen. You need it to survive. You need it to think clearly. You need it to execute without hesitation. A 1:3 strategy is like freediving deep underwater. You take a breath, a win, and then you have to hold your breath for a long, long time. You might go 2 weeks without a win. You are swimming through the dark, lungs burning, waiting for that next hit of 3R. The pressure builds. The panic sets in. Most traders pass out before they reach the surface. They panic. They drown. They quit. A 1:1 strategy is like snorkeling. You breathe constantly. Win, win, loss, win, win, loss. You are getting a steady supply of oxygen. You are never starved for confidence. You are always near the surface. When your brain is starved of wins, when you are in dopamine starvation mode, strange things happen to your perception. You start to hallucinate. You start seeing setups that aren't there. Why? Because your brain is desperate for relief. It needs a win to validate that you aren't a failure. So it tricks you into taking a subpar trade just to get a fix. That looks like a support bounce. You tell yourself, even though it's in the middle of nowhere. This is why high RR traders often overtrade. They are starving. They are forcing the market to feed them. But with a 1:1 system, you are well-fed. You just had a win yesterday, maybe 2 wins. You feel good. You feel successful. You aren't desperate. You can wait for the perfect setup because you aren't frantic for validation. There is also a biological phenomenon known as the winner effect. Biologists have studied this in animals and athletes. When an animal wins a fight, its testosterone levels rise. It becomes sharper, faster, and more confident. It is more likely to win the next fight. When an animal loses repeatedly, its cortisol, stress hormone, spikes. It becomes fearful, hesitant, and slow. It enters a loser spiral. A 1:3 system keeps you in a state of high cortisol, losing mode, most of the time. You are constantly managing loss. A 1:1 system keeps you in a state of high confidence, winning mode, most of the time. You trade better when you are winning. It's a fact. A 1:1 strategy is designed to keep you winning often, so you stay in the hunter mindset rather than the prey mindset. It hacks your biology to keep you performing at your peak. Chapter 3. Duration risk. Time is the enemy. There is a concept in physics called entropy. Simply put, chaos increases over time. The longer a system is running, the more likely it is that something random and chaotic will happen to disrupt it. This applies directly to trading, but we rarely talk about it. We talk about price risk, but we ignore duration risk. The longer you stay in a trade, the higher your duration risk. Hitting a 3R target usually requires holding a trade for a significant amount of time. Maybe 4 hours. Maybe 2 days. During that time, what can happen? A random news event. A tweet from a central banker. A sudden liquidity spike. A reversal in trend. A session change. You are exposing your position to the chaos of the world for a long duration. You are hoping that for the next 8 hours nothing crazy happens. Hitting a 1R target requires being right for a short time. You enter. Price pops. You exit. You are exposed to the chaos for 15 minutes instead of 4 hours. You are in and out before the chaos can find you. Let's be honest about retail trader skills. What are we actually good at? Retail traders are actually pretty good at predicting impulse. We can look at a chart and say, it looks like it wants to pop up here. And usually it does pop up. It goes 15 or 20 pips in your favor. We get the direction right initially. But are we good at predicting destination? Are we good at knowing exactly where the move will end 4 hours from now? No, we are terrible at that. The market is too complex. How many times have you entered a trade, watched it go to +1R or +1.5R? You saw green. You felt good. But you didn't take profit because my plan says 3R. I need to let my winners run. And then you watched it reverse. You watched it grind all the way back. You watched it go red. And you watched it stop you out. You turned a winner into a loser because of dogma. You turned a reality, profit in hand, into a fantasy, profit on spreadsheet. There is no pain quite like watching a winning trade turn into a losing trade because you were too stubborn to take the money. It makes you feel stupid. It makes you tilt. The 1:1 philosophy is, capture the impulse and get out. We are not investors. We are not holding for the long term. We are extracting inefficiency. When the market gives you the easy move, take it. Don't stick around for the difficult move. Greed often masquerades as patience. Holding for 3R when the market structure is breaking down isn't discipline. It's greed. It's refusing to accept what the market is offering because you want more. The 1:1 trader accepts the gift and leaves the party before the fight breaks out. Chapter 4. Confidence Capital, the hidden account. We need to redefine what capital means. You have 2 accounts. Account A is your financial account, dollars. Account B is your psychological account, confidence capital. You cannot trade if either of these accounts hits 0. If you run out of money, you're done. But if you run out of confidence, you're also done. You just don't know it yet. A trader with 0 confidence becomes gun-shy. They see a perfect setup. Their system says buy, but they hesitate. Their finger freezes. They remember the last 5 losses. They are scared of the pain. They miss the trade. And of course, that trade goes to the moon. Now they are tilted. Now they chase. A 1:3 strategy is very hard on your psychological account. It makes huge financial deposits, 3R wins very rarely. But it makes constant, draining withdrawals from your confidence, loss, loss, loss. It is a volatile emotional bank account. It is constantly in overdraft. A 1:1 strategy keeps the confidence account full. You win more days than you lose. You end the week green more often. This creates a feeling of safety. When you feel safe, you execute flawlessly. You don't hesitate. You don't second guess. You trust your ability to pull money out of the market because you see it happen frequently. You walk up to the chart knowing that you are likely to win today. That mindset is priceless. Think about scaling your position size. This is the ultimate goal, right? To trade big money. Imagine you want to trade with 10 lots. That is scary size. Every pip is hundreds of dollars. Would you rather trade 10 lots on a system that loses 7 times in a row? Could you handle a $10,000 drawdown? Would you sleep at night? Or would you rather trade 10 lots on a system that wins 65% of the time? It is much easier to scale up a high win rate system. And that is the secret to wealth. You don't get rich by making 10R on a tiny position because you are too scared to size up. You get rich by making 1R on a massive position because you have total confidence in your strike rate. The 1-to-1 ratio gives you the psychological stability required to eventually trade big size. And size is what pays the bills, not our multiples. Chapter 5. The base hitter, compounding consistency. Let's use a baseball metaphor. Everyone wants to be the home run king. The guy who points to the fences, swings as hard as he can, and smashes the ball out of the park. That is the 3:1 trader, the YouTube guru. But home run hitters also have the highest strikeout records in history. They swing and miss constantly. They have long slumps where they hit nothing for weeks. Now look at the base hitter. He doesn't swing for the fences. He just wants to make contact. He hits a single. He gets to first base. The next batter hits a single. He gets to second base. They score runs consistently, inning after inning, game after game. They are relentless. The base hitter wins the World Series while the home run king is trying to fix his swing in the batting cages. Visualize the equity curve. The 3:1 equity curve looks like a jagged mountain range. Deep valleys of drawdowns followed by sharp spikes of profit. It is stressful to look at. It is stressful to live through. Your mood swings with your equity curve. The 1:1 equity curve looks like a gentle ramp. It moves up, pulls back a little, moves up again. It is smooth. It is boring. And boring is good. Boring is consistent. Boring is professional. Boring makes you rich. Excitement makes you broke. If you aim for 1:1, you are choosing the path of the base hitter. You are choosing the path of the grinder. You are saying, I don't need to be a hero. I don't need to catch the entire trend. I just need to get paid. Consistency is built on the frequency of reinforcement, not the magnitude of reward. A dog learns a trick faster if you give him a small treat every time he does it, rather than a giant steak once a month. Your brain is the same. It needs reinforcement. Feed it small wins. Feed it often. And watch your consistency explode. I want to invite you to make a shift. A temporary one if you are scared. Stop trying to be a sniper. Stop trying to be a guru catching the top and bottom. Be a mercenary. A sniper cares about precision and distance. A mercenary doesn't care. A mercenary cares about the contract. Get in. Secure the package, the profit. Get out alive. The market is handing out money every single day. It is handing out 1:1 trades constantly. Impulse moves. 15 pips here. 20 pips there. Setup after setup. Most traders refuse to take them. They turn their nose up at them. That's not enough, they say. I need a 5R trade to be a real trader. And so they starve. They starve while standing in the middle of a buffet, because they are waiting for a specific dish that isn't being served. Try it. For the next 30 days, ignore the gurus. Ignore the golden ratio. Set your target to 1:1. Focus on finding high-probability setups where you can just get a single base hit. Focus on your win rate. Focus on keeping your confidence account full. Watch your win rate soar to 60% or 70%. Watch your stress vanish. Watch your P&L turn green. You don't need home runs to retire. You need a paycheck. The market is ready to pay you. Stop waiting for the lottery ticket and take the paycheck.